Taxes are more than just an April headache. They directly affect your budget. They reduce what you keep from your investments. They impact how fast you can climb in and out of debt. Today, we start a new monthly series. We begin talking about taxes. We begin with the absolute basic, how the system really works, the key concepts everyone should know, and why this matters in our post-COVID-19 world. So let's get to it. Let's start our next journey in the climb.
Life is full of choices, but how do all these choices connect? And how do we plan for what matters most? Because when your life goals align with the right financial strategy, you don't just dream, you climb.
Quick recap and why taxes matter now. Let's quickly connect back to what we've already covered. In episode 1, we looked at COVID-19 and how it changed everything. Massive debt increase, inflation spikes, markets rebounding, and AI acceleration. Episode 2 gave you practical tools, budgeting methods, emergency funds, and debt management. In episode 3, we moved into investment basics, index funds, diversification, tax advantage accounts. As you know, taxes touch everything, every single one of those areas. If you ignore taxes, your emergency fund grows slower, your investment returns get eaten up by taxes, your debt payoffs takes longer, and right now, we're right in the middle of this. In 2026, we're filing for taxes for 2025. Brackets have been adjusted for inflation. The rates themselves have not changed, still from 10% to 37%. But people who understand the basics keep more of what they earn. People who don't often pay extra or get unpleasant surprises from Uncle Sam. So let's make this simple and clear today. Let's get right to it and go over the concepts that you need to learn to navigate the tax system. First big idea, the federal income tax is progressive. That means higher income pays higher taxes, but not on everything, only the portion above certain levels. You do not pay top rate on your entire income. Let me show you with a clear example. Suppose you're a single and your taxable income after deductions is $60,000. Here are the 2026 tax brackets for single filers. The first $12,400 is taxed at 10%. So if you take $12,400 times 10%, that portion is taxed at $1,240. Next portion from $12,401 to $50,400 is taxed at 12%. That's $38,000. At 12%, the tax bill is $4,560. Then the remaining amount from $50,401 to $60,000, which is $9,600, that portion is taxed at 22%. The tax is $2,112. If you add all these together, your total federal income tax is approximately $7,912. Your marginal rate, or the rate on the latest dollar, is taxed at 22%. But your effective rate, which is what you actually pay on the overall amount, is only taxed at 13%. That's the power of the progressive tax system. Higher rate applies only to income in that higher bracket, not to every dollar earned. Very important. Now, your filing status, that's another thing that's very important. Filing, what are the options? Single, you may file married filing jointly. That often offers the lowest effective rate for couples. Married filing separately, head of household. That can be used for different options, but that's usually for single parents who have dependent children. Choosing the wrong status can cost you thousands. Withholding is how taxes get paid during the year. Your employer, for example, withholds estimated amounts from each paycheck. You set this on your W-4 form. If you withhold too little, you owe at tax time. But if you withhold too much, yes, you get a refund, but that money you've loaned to the government is interest-free. In other words, you pay the federal government a higher withholding than you should. They say, thank you for lending me money. Here's your refund, but you get no interest. You get no dividends. You get nothing for the government money. Now, what are the other taxes to consider? State taxes. And those are separate from federal income taxes. Let's make sure we don't confuse that. In fact, there are 9 states that have no income tax: Florida, Texas, Nevada, and others. But consider this, just because a state does not have state income tax does not mean they don't have other means of collecting revenue. They may charge toll road taxes or higher property taxes or higher sales taxes. There's other creative ways in which states can collect revenue. On the other hand, there are other states, like the state of California, who tops state income tax at 13.3%. That is the highest in the country. And for some people in certain cities, there are some local state income taxes as well. Yeah, you heard that right. There are some cities that also charge local state income taxes. Now let's cover the most important basic terms. Tax bracket. There are 7 of them for 2026. 10%, 12%, 22%, 24%, 32%, 35%, and up to 37%. What is the marginal rate? Marginal rate is the rate that applies to your next dollar earned. And remember, there's an effective rate. Your effective rate is usually lower. It's your total tax divided by your total income. We have gross income, everything you earn before any subtractions. And then we have what's known as adjusted gross income, or AGI, which is your gross minus certain adjustments like IRA contributions, for example. You have taxable income. What is taxable income? What's left after deductions? That's what gets taxed. Standard deductions, that's what most people take. For 2026, the standard deduction, $6,100 for single or married persons filing separately, $32,200 for married filing jointly, and $24,150 if you're head of household. If you itemize deductions are higher than the standard deduction, then you itemize instead of taking the standard deduction. It just depends what's more beneficial for you. What are the common forms we use? 1040 is the most popular for people. And then your W-2 forms. This is a form that your employer provides you where it shows your wages and withholdings. Another important form is your 1099 forms. Those are things for things like freelance work or self-employment income, interest, dividends, or other investment sales. Now remember, the tax deadline is usually April 15. You can always file an extension to October 15, but you must pay any taxes you owe by April 15 to avoid any potential penalties and interest. Now, how does this connect to what we've already learned? Well, from episode 2, we talked about your budget, tracking income and expenses, helping you spot possible deductions. For episode 3, your investments, know that short-term gains are taxed at ordinary rates. Long-term gains are taxed at lower rates. Let's dig a little deeper into that right now. Capital gains are profits from selling investments like stocks, ETFs, other short types of investments. Short-term means you held the investment for 1 year or less. These gains are taxed at ordinary income rates, the same as your salary, up to 37%. Long-term capital gains means you held it for more than 1 year, and those get special lower rates. 0%, 15%, and up to 20%, depending on your total taxable income. So let's take an example. For 2026, for a single filer, if your taxable income is under $47,025, long-term capital tax rates are at 0. You heard it right. If you made $47,025 or less, if you make that amount, your long-term capital gain will be taxed at 0%. Now, above that, so at $47,026 to about $518,900, long-term capital gain is taxed at 15%. Anything above that, congratulations, you're making a whole lot of money. That's a whole lot of money to make. You're taxed at 20%. What does this all mean? Holding longer saves big on taxes. It rewards patient investing. Interest from your emergency fund account is taxed at ordinary income. But it's still smart to keep a high yield account for emergencies. Who knows? You need an expenditure, you lose your job, you get sick, an unplanned home renovation. You have an emergency fund available to cover those expenses. People who skip the basics often leave money on the table, and those that don't understand this tax code and system, and they optimize how the system works for them. Our main takeaway today: tax basics are not complicated. They give you control over more of your money. 3 simple actions for this week. First, gather any 2025 W-2s or 1099s you already have. Second, plug in your rough income into a free online tax bracket calculator. See where you might land. Third, look at the latest pay stub. If your withholding seems way off, consider updating your W-4. In next episode, we go a level deeper, intermediate taxes. We talk about deductions that lower your taxable income, credits that reduce your tax bill dollar for dollar, and practical strategies to use them. Then we'll finish the series with CPA Richard Duran, the key expert in our discussion.
Life is full of choices, but how do all these choices connect? And how do we plan for what matters most? Because when your life goals align with the right financial strategy, you don't just dream, you climb.